The FOMC isn't the only central bank in focus here. We heard from the European Central Bank, the Swiss National Bank, and the Bank of Canada this week, all cutting interest rates as inflation moderates and uncertainty around the globe continues to loom. Markets pricing in that near 100% chance the Fed will trim by 25 basis points next week, while the Bank of Japan is expected to hold steady for the fourth consecutive month. Here with how investors should play the global divergence in rates, we've got Vincent Deluard. He is the Director of Global Macro Strategy at StoneX. Great to have you on here. So talk to me about this divergence that we are seeing. Central banks globally cutting ahead of the Fed potentially pausing as early as December. What is the significance of that divergence for U.S. investors specifically?
Well, I think the divergence is really coming from the fact that every major central bank is looking at something slightly different. In the Fed, for the Fed, it's all about inflation. This week's print was a bit too hot. They kind of dismissed it, but if we keep getting these slightly hotter than expected prints, it's going to be hard to cut more than once. I mean, effectively, December is baked in. For the Bank of Japan, it's all about the yen, and we've seen the yen weaken recently, which would also the case for maybe not waiting too long for a rate hike. And for Europe, it's all about politics. We have this very messy political situation in France, elections in Germany. My base case on all the three is that the Fed is going to be probably tighter than the market expects them to be because inflation is not coming down as much as they like. And in Europe, on the other hand, the European Central Bank might be a bit looser because the economic impact of the crisis is really felt, and that's really the only option. So I would be looking at 50 basis point cuts maybe in Europe, and the Fed cutting only once and then going on a long break.
How does that then impact your global growth projections, what you're expecting to see then next year? Any sort of adjustment then, given the fact, especially here in the U.S., that we might not have as an aggressive as the Fed, which could be good news, I guess, depending on how you look at it here, heading into the new year?
Yeah, I think in general, growth has been steadier and stronger than economists have expected for a long time. We're still getting the tailwind of that. GDP, if you look at the Atlanta Fed GDP now model, we're running at 3.3%, which is really outstanding. I mean, when Scott Bessent goes out and says, I want the 3.3s, right? 3% GDP growth, 3 million barrels, and then 3% deficit. The deficit won't get, obviously, but the 3% growth, I mean, man, we've had it. This is 8 quarters at 3% growth. 3 million barrel, we also have it. So my general impression, the economy is good. And the Fed probably should be paying more attention to the inflation mandate than the labor market. We'll see labor market probably tighten a little bit as we restrict immigration. So that would really justify a cautious approach for the Fed when it comes to rate cuts.